Good morning, everyone. It is June 29th, 2022. We've got a great show for you this morning. Good morning, Tyler. How you doing?
Morning. I'm doing all right. I'm doing all right. I think we have a pretty great show today. We're going to look at how we can use Folico data to look at dollar sensitive assets. The dollar's been pretty important in this Fed hiking cycle in terms of, dollar up has been pretty painful for risk. So we're going to look at, what we can kind of see from our data between the next 1 and 12 weeks.
Absolutely. So for those of you who haven't joined us before, Tyler and I are working in a company called Cinerai. We made a product called Folico. And what we do is we build a whole bunch of artificial intelligence powered engines that crunch in everything we call open source data, which is everything you could find from doing some really good Google searches on the internet, but on steroids, right? So we take millions and millions of different data points from what people are saying. We crunch that with the most sophisticated natural language processing engine in the world. And then we use that intelligence to make stock market predictions. We make predictions in Foliko on a 1 day out through 12-week basis, right? And then comparing that trend of where we expect a company's stock to go, it gives us a really good understanding of what's happening in the market. So for today, we're going to dive deep into what this says about all the assets that are deeply entangled with the dollar and the value of the dollar and what that means for everyone's portfolios going forward. It's going to be a great show. But first, I want to get a little bit of the market feeling of today. What's going on today, Tyler?
Well, we just gave back in equity indices futures. We had some lower than expected CPI data in Germany, which had given us a temporary push, but we're back red here. Across the indices, it looks like QQQ just turned red as well to go with SPY. Commodities, like we're going to talk about later, a little bit higher. Crude's back over 113. That's not necessarily something that we see as being a positive for risk in general.
Gotcha. So Germany CPI lower, but then I hear members of the Fed coming out and saying 75 still absolutely on the table.
I mean, yeah, they're talking all that good stuff, especially now that they've transitioned away from talking about outright rate levels and talking about wanting to turn real yields positive, which I think would be pretty painful for the market, and that would mean a willingness to hike the funds rate through the rate of inflation. That's not what our data says they're prepared to do. So we can dive in.
Well, given how quickly they changed from 50 to 75 last week, just based on some data that came all of the sudden, I'm disinclined to believe their long-term promises. I don't know about you.
Yeah, and that'll ultimately be the question: is after they get this initial adjustment behind them, do they have the will to inflict, what would be some pretty substantial pain if they, decide that they don't care about some of the knock-on effects and just decide to push through.
So our forecast on dollar-sensitive assets, then, what does this mean for that?
So it's very interesting because as we showed you yesterday, we came out with a net negative EM view. We saw some pockets of strength, but overall, when you look at the ETFs, we aside from EWZ, we generally prefer to be short. And that would be, generally speaking, EM assets don't perform as well when the dollar's rallying. We actually see kind of a different story here in our forecast, and I'll bring them up. So this is just a sampling from some of the commodity / dollar sensitive ETFs. So this is gold miners, this is copper miners, steel companies, and then XME, which is the metals and mining ETF, which comprises of a lot of these that are above. We have Alcoa here because I just want to show you something on Folico later. But what's interesting is we actually have some pretty decent performance in some of the gold mining stocks. We see copper doing okay. We see steel doing, pretty well. We see kind of a blue chip commodity name like Alcoa sideways to higher. So that to me kind of suggests that, the Fed's not going to be able to crush inflation or want to, rather. If inflation is kind of stuck at, say, 5.5% or 6%, I don't think they're hiking the funds rate 6.5%. And that's what this data says. This data says that the Fed is not willing to completely stomp out inflation, because if they were, the forward performance of these assets would be significantly worse, in my opinion.
So what does that mean then for inflation going forward?
It means, well, it could mean a lot. I mean, there are a lot of different outcomes for inflation that get you this output. But to me, it just kind of says, yeah, sure, inflation will come back a little because the components that can be controlled, by on the demand side and dampened by Fed rate hikes will be controlled, and it will push, parts of inflation lower. But there are other parts that, are not coming lower because either they're going to be a bit more sticky than we thought, or they're supply side driven. So, to me, it just it's a kind of a stagflationary, forecast and asset allocation for that situation.
Interesting. Right. So when it comes to these, we have built a new set of models that can do some understanding. So we can compare these indexes directly with each other or with the market. Tyler, I want to go over and take a look at exactly when you put all these numbers together and when you compare it with all the tickers on our coverage list, what exactly does that mean? And how strong are the statistics leading us in one opinion or the other? So, all right, I'm going to bring up my screen here. And here we have all this tickers under gold for copper and for steel. And then this was yesterday's show on emerging markets. So I was just taking a look at that. And what we can do here is put in all the gold tickers and compare that. First, we're going to compare that with the stock market just in general. So I want to show you what this is going to look like. So these are going to be p-values. And you can... There's something called a null hypothesis for this test, where you decide your confidence level. You can have an alpha or a confidence level of 0.1 or 0.05 if you want to be really certain of an outcome. But in essence, what you're saying is this first hypothesis is that gold stocks are going to end up lower than the rest of the market. Okay. Here, you can say gold stocks are going to end up at about where the rest of the market is going to be. And then finally, that last hypothesis is that gold stocks are going to end up being better than the rest of the market. So if we end up lower than 0.05 on this, that means that we believe, or the data is showing, that it is consistent with this hypothesis right here. So, and this is, I have just made this a little bit easier for those that are deep into statistics. What you're really doing with this is rejecting the null hypothesis and accepting the alternative. I've made it a little bit easier to understand by saying the alternative is that it's going to be less. The alternative is that it's going to be equal and greater. So what we show here is a fairly strong confidence that gold stocks are going to be performing better than the rest of the market, right? So this is at the alpha 0.05 level, meeting that alternative hypothesis. So there's strong statistical significance to show that gold stocks doing better. What's cool about this, though, is that we can introduce, we can compare these two things directly with each other. So we can say gold versus copper. So if you're thinking, I want to get into one versus the other, which one should I go after? And so what this shows here is, we don't have enough data, right? Remember, before we were comparing, what is this, about 10 tickers with roughly 1,100 tickers, and that gave us enough data to be fairly confident about what we were seeing. Oh, and let me zoom in here, make sure everyone can see my screen. When we compare just 10 with 3 different tickers, it's going to mean a lot less data, but the level of the numbers is still going to be informative. So us saying that gold is going to have a weaker trajectory than copper is our strongest hypothesis here. So copper, in other words, being the better performing set of assets than, say, gold directly. If we put in steel, what we show here is steel being the better, significantly better performer than steel, or steel being better than gold. And now let's have a winner's circle here: copper versus steel. Looks like steel is winning out, Tyler. Does that make sense? So, any questions? We do have the ability to come in and answer questions. So if you have any questions, feel free to drop them in the chat. We can answer those live for you here. But that's what the numbers are showing us. Pretty strong conviction. If we do here just steel versus the rest of the market, look at that. Very, very strong conviction that it is equal to or greater than how the rest of the market will perform. So that shows me that in that sector, we're seeing something pretty significant.
Yes. And so if, first of all, I think, we're the only people looking at relative strength like this, pre-market. This is like, I referred to it as RSI on speed yesterday. What we're doing basically, like it's, this ability to look at different sectors and differentiate is I think pretty important and I think, certainly very powerful. So to show you what we want to do with that, then Cliffs and US Steel would be our favorite names on the list, given the analysis that we just did. We see Cliffs, up 30, almost 31% in 12 weeks. So that's some pretty chunky upside there. Like we said, we do see some decent performance in some of these other pockets, but given the analysis we just did, I think, far and away, you ought to be focused in here.
Interesting. So copper and steel doing better than gold. Systemically, what does that tell us then?
It's interesting because I would expect in a risk off, negative growth scenario that we would see, copper lower, gold, flat to higher, and, steel could go, either of those direct, I could draw you up different scenarios where steel's higher and lower, with either of those. But it's interesting because that actually is a bit more positive than I actually thought we would find. Given our overall bearishness in risk in general, I actually would have expected some more weakness in the copper stuff, especially, the last 30 years, I think every recession has followed a bear market in copper. So that would be the kind of thing I would expect is if we're going to get a true recession and follow on in this bear market as a result of this recession, I would have actually expected negative copper performance, which actually isn't what we're seeing here. So that's interesting. And it does kind of point to, we are in the beginning of turning back constructive on risk. I think, we got long biotech last week. We had mentioned we're looking for lows and fangs sometime in October. So maybe this suggests that things do start to change. But just by our forecasts, it kind of looks like a stagflationary, be long commodities situation to me.
So we got a question from AI powered swing trader. Any nickel considerations for growth?
Yes, but more, I would say that's more in terms of like energy and fuel. When I think of nickel, I think more of like, Tesla and things like that, as opposed to, traditional oil, copper, growthy commodities, if that makes sense.
Interesting. All right. So now you were saying something, we were talking a little bit yesterday as we were doing some research and prepping for today's show. You were talking about China and its relationship with copper. So what does that tell us?
Well, so basically, China is one of the, if not the marginal buyer of copper. So they, if they're buying, the price is going up. Generally speaking, their demand, or therefore lack of, has a very large imprint on the market. And it's been performing terribly lately, and that kind of makes sense because China's locked down. So you really kind of need to see what happens when the lockdowns, are lifted. How does copper perform? If copper keeps falling after the lockdowns are lifted, that would be an interesting signal to me. But I think we're going to kind of have to wait and see. There's a lot of this macro picture that is wait and see on what happens when as lockdowns start to lessen. What happens with demand? What happens with the ability to increase supply? And that's, a large amount of this betting on, will they, won't they inflation is how you think the global asset markets are going to react to, the biggest country in the world just flipping back online, for lack of a better term.
Fair enough. So you had mentioned that you wanted to go a little bit deeper into Alcoa. What are we seeing with Alcoa then?
Yeah, so this one, I think this one's very cool. So this to me is, let's see, did I do it? This to me is the power of Folico. So we have Alcoa stock, which is, they just left that thing for dead since, the market in general since early June has stunk, but they really have just, beaten up some of these commodity stocks. And you'll see that here. But what we are seeing is earnings power never agreed with that move lower, and in fact is starting to move higher here, across some time frames, turning positive. So we have earnings in 16 days here. This is one of the best examples of when I talk about like bullish or bearish earnings divergence. This is what I'm talking about. The earnings power has completely gone an entirely different direction. These things usually track somewhat. So when it gets lost like this, it usually means a pretty explosive move is coming. So this is something I definitely want to monitor, going into the next 2 weeks, because if we don't get any adjustment higher in the stock, that might be a nice earnings bet.
We do have another question. Very firm copper price ahead despite recent drop. What can Foliko say on this this element?
Can you put it up on the screen so I can read it?
Yeah, so we actually have another user showing it to us. I'm wondering why we're actually not getting that question directly in this chat streamer, but this is from Troy Ed, who is passing on a message from Codelco.
I think we tend to be on the side that especially given our forecast in some of these copper stocks, that copper is going to at least stabilize somewhat. It's been in a pretty decent free fall, copper and all the copper stocks, for the last, I'm just checking. I don't remember what periodicity I was looking at, but I saw a lot of red bars in the chart. Yeah, I look at FCX, which is a big copper miner. That's just gone straight down since the 7th of June. So, I do tend to agree that we have a snapback on the way there. A lot of people are already pointing to the copper price falling, which means it's most likely to stop falling, at least, while everyone's staring at it.
And is that then to do with the Chinese lockdown?
Yes. Yes. As I mentioned, the whole thing's basically a bet on, how much demand will change for growthy commodities and industrial commodities, with them back all the way online.
Now, there's been forecasted since 2017 that there's going to eventually be a huge housing crash in China. I know construction there is just incredible, right? Like a significant portion of all the world's construction is happening in China. I imagine that's what's really bringing in a lot of this copper. If there is that housing crash in China, do we start to lose that correlation between copper prices and Chinese construction, or what's the story there?
Yeah, I would definitely think so. But there are so many different levers they can pull, so many different financing schemes available to make sure that they're able to offload the risk. It could happen, but it's just one of those things that will happen all at once when nobody's looking, as opposed to the longer you stare at anything, the less likely it is to happen. I think, this is one of those things where, yeah, I'm sure, is there a scenario in our lifetime where we wake up one day and it just happened? Yeah. But it won't be while anybody's, looking for it. That's, if I've learned, one thing in the markets, it's stuff moves when people stop looking at it, to move to that direction. So, that's kind of how I think about that.
We have a question in right now from Cold Heart. Cold Heart says steels have hit lows right now in some Asian markets. Would there be a chance for it to rebound in the long term? Looking at steel has overtaken gold in U.S. markets, as you said.
Yeah, I mean, I don't think steel is overtaken gold in terms of their functions. Steel is still a commodity. There's lots of it, right? It's not a precious metal. It's just a simple commodity metal. So I don't want us to be heard as saying buy steel instead of gold. No, it's two different things. We just think the steel stocks are going to outperform. That being said, though, we have some pretty bullish forecasts on U.S. Steel, which is ticker X. We have that up 28% in the next 12 weeks. And we also have ticker CLF up about 31% in the next 12 weeks. So if you were looking to play a rebound in steel, those are our best ideas.
Excellent. Tyler, I think this sets us up for a pretty good understanding. And I think we're actually pretty good to go for today. This has been Folico Live. You can join us every morning at 8:30 a.m., Monday through Thursday. I do want to let our audience know, or start letting you know, next week we're going to be out for 4th of July. That's Monday. Markets will be closed anyway. So we're going to be doing our weekly earnings roundup next Tuesday on July 5th. I believe that is July 5th, next Tuesday, right? Yes. So join us July 5th for our weekly earnings roundup, where we're going to be going through that week's earnings reports and what we expect on them, and join us then. Also on Friday, you're not going to want to miss it. We do our weekly report card show, where we're going to go through every prediction that we've made throughout the week and give ourselves a grade on whether or not we hit the mark, and how we're going to be changing the models to improve the mark for anything that we did miss. And then we do have a question here before we close out. Rush to Vish is asking, are we going to have a session on health factors? I think this is a great idea. So actually next week is education week for us, where we're going to be releasing some recorded segments on exactly how Foliko works, what these health factors are. And that way in our shows going forward, we'll be able to reference those educational pieces to anyone that's newly joining the show. So if you're wondering, how do I use management? What has been the historical performance of having a management-based portfolio in our health factors? We're going to go deep on all of that. Tune in next week. Tyler's going to be queuing things up. He's going to go through what the markets are saying and things like that for a few minutes. And then he's going to be going right into some educational sessions on what these health factors are, how they're built, how to trade on them, and what the historical performance of trading on them has been. So you're not going to want to miss it next week, 8:30 a.m., Tuesday through Thursday, with report cards on Friday. And then we'll be back really soon. So thank you, everyone, for joining. Folico is live now for subscription. So head on over to www.cinerai.com, and we'll be back tomorrow. Thank you all.